Welcome again to our Taking Stock episode for the week ending the 29th of August, 2025. I'm Kien, Trinh, Head of Research at Stock Doctor, and joining me today is our Senior Portfolio Manager, Matthew Swartz, to stream to you all things share market. How are you, Matt, on this reporting season day, the final day of reporting season?
Well, it's lovely to be the final day. It's been long, but it's been really encouraging for many of the stocks within the Star Stock universe. The funds are doing really well for the month, so I'm particularly pleased.
Yeah, me too, Matt, with Star Stocks outperforming for the month to date. But as always, the information we provide is of a generic nature and won't consider your personal situations or needs. Shares are volatile, so any past performance figures aren't a reliable indicator of future performance. Well, Matt, it's been another roller coaster week for investors. It's not unusual given that we've hit the most volatile stretch of earnings season. Markets are up around 3% this month and 15% for the year to date. But share price reactions around result day have been unusually sharp. In fact, this week could go down as the most volatile week we've had in over a decade from all the reporting seasons.
Yeah, that's right, Ken. It is volatile out there at the moment. And many in the industry call this week the small caps and stragglers week, where you get that final wave of companies that are oftentimes more volatile and thinly traded, delivering their financial results. And volatility has spiked, and this dynamic is due to passive investing and fewer active price setters, and it creates these conditions for great volatility. And large caps aren't even immune. So we've seen this week Woolworths, Bank of Queensland, Wisetech, Ramsay Healthcare, and even Domino's, which all saw very sizable downward moves. And this is happening in an environment where market valuations are still looking a little stretched. The All Ords is trading at 20 times forward earnings, which is well above historical averages.
Yeah, that chart does look concerning there, Matt, but it's happening despite the soft earnings outlook. We've had cost cutting, not revenue growth. That's been the key driver behind many of these results. In fact, more than 40% of firms have referenced cost efficiencies on their calls, while 36% have beaten expectations on the earnings front. Only 15% have beaten on top line revenue. And that disconnect does speak volumes about the quality of this season's beats.
And investors are also digesting a bit of macro in that fresh inflation data, and headline CPI came in at 2.8% in July, driven largely by surging electricity prices and delayed government rebates. That's right at the top of the RBA's target range, and it has cooled hopes of another September rate cut. Markets are now seeing November is more likely.
Yeah, that's true, Matt. And this could ultimately lead to some volatility in coming months, especially when valuations are elevated. So please ensure you trim your profits along the way and manage the portfolio risks. But let's now turn our attention to a few Star Stock highlights for the week. Let's start with supermarkets, often seen as defensive, Matt. But Woolworths, they reminded us that even the biggest staples are not immune to execution risks. Despite their solid brand equity and supply chain scale, their share price took a tumble after a weaker trading update and signs of lost market share in core Australian food operations.
Yeah, it was a tough week for Woolworths investors, and investors were especially disappointed by soft like-for-like sales and muted fourth quarter performance. Even after the supermarket has invested in price to drive volumes, tobacco reforms and system upgrades are weighing on near-term profit, which should prompt FY26 earnings downgrades of around 6%. The dividend yield remains respectable at 4.4%, but questions do linger about whether it's sustainable with the high payout ratio in 2026.
Yeah, and in contrast, though, its competitor, Coles, they delivered a cleaner result. Management does continue to execute well, cutting stock losses, lifting gross margins, and also strengthening online and in-store operations. Investors rewarded this discipline with their sharp share price rally. And with online sales rising and capital efficiencies improving, Coles does appear better positioned to navigate this cost inflation environment and pricing competition. Hence, its dividend yield is now below Woolworths at around 4%.
And turning our attentions to telcos, Spark New Zealand, controversial, I think, has returned as a star income stock after taking decisive action earlier this year. Dividend sustainability is now stronger thanks to a reset in its payout policy, which is tied to free cash flow. With net debt falling and cost savings underway, the current 6.7% yield looks more achievable, with full year expectations now around 15 cents per share.
Yeah, bear in mind though, but that's also translated from New Zealand dollars. But Yeah, they had to cut their dividend, but it still looks quite attractive. Spark is leaning also into the growth avenues as well, investing in data centers and AI-driven infrastructure, but doing so now within their clear capital management boundaries. That balance between growth and income is now key for them. After earnings downgrades over the last couple of months, management does now look at their new guidance, suggesting some stabilization, and with the New Zealand economy showing signs of a recovery as well.
And also this week, we initiated medical imaging company Integral Diagnostics as a star income stock. Now, this business is benefiting from secular tailwinds, such as MRI deregulation and national lung screening programs, all of which are expected to lift imaging volumes. And importantly, IDX is delivering cost synergies from the Capital Health merger faster than was anticipated, and this has been supportive for share price over the last few months.
And I also notice here, Matt, that despite the labour challenges, we've seen radiologist availability. That's improving here as well. And with earnings visibility increasing and dividends expected to rise over the coming years, IDX does represent a good income opportunity within that healthcare space. Currently, it's on a gross dividend yield of around 4.4%.
And lastly, Jumbo Interactive posted a really solid result and the share price rallied strongly. Even though revenue did fall on subdued jackpot activity, profit margins did remain quite solid, and the balance sheet is pretty clean. The dividend yield sits at a healthy 6.4%, and management did reaffirm guidance and plans to continue the on-market share buyback, which suggests that the stock is still undervalued.
Yeah, definitely. Here you're getting a bit of growth and yield as well. Jumbo is investing more in that marketing just to defend its market share, particularly in digital lottery channels as well, with further earnings growth, especially from software as a service and managed services. And there's also potential for M&A activity ahead. The company is well placed to diversify its earnings and also improve its return on equity, currently forecast at around 37%. But meanwhile, there's been plenty of strong results, including retailer Lavisa, wealth platform provider Premium, and also electricity distributor IPD Group as well. So please refer to our commentary for the full details. Now for Under the Microscope. This week we're focusing on global logistics business, Wisetech. Its flagship platform, CargoWise. It supports customs declarations, freight bookings, and also warehouse coordination as well. But the business has had a turbulent year, both operationally and also in governance. Founder Richard White, he stepped down last year amid controversy, but returned as executive chairman in February, but also appointing longtime ally Zubin Apu as CEO in July.
It's been a turbulent year, hasn't it, Kien? The FY25 result was the first under this new leadership structure of sorts. And while earnings did look solid at the surface, revenue was up 14%, underlying profit was up 30%, the market was still very disappointed. CargoWise revenue growth guidance for FY26 came in below expectations at 14 to 21%, and the share price, which rallied strongly into the result, dropped around 12% on the day.
And I think also, Matt, part of that disappointment stems from elevated execution risk and margin pressure. Wisetech's recent $3.2 billion US acquisition of US-based E2 Open will lift the group revenue by over 80% in financial year 26, but it also comes at a cost. The new business is lower margin, and there's also integration costs, which are expected to weigh on its earnings in the short term.
And financial health remains sound for now, but this could weaken into the next period when the full impact of debt and intangibles flow through. Despite this, return on equity is expected to stabilise to 16.6% in FY26, although we expect earnings downgrades to flow through after this result.
Not surprisingly, though, with the sharp share price decline, the share price is now trading at a meaningful discount to its consensus target price of $135. But with that said, though, it still commands a high PE multiple at 66 times. Investors now face a tough decision. You either back the long-term growth story or you wait for better clarity on execution, its financial health, and also its new leadership.
And with Wisetech positioning itself as the Microsoft global trade, the potential upside is really large, but the pathway does have its risks.
And now for question of the week. With Spark New Zealand recently reinstated as a star income stock, a few of our members have asked us an important question. How do we assess the sustainability of a dividend yield?
Look, it's a great question, Kien, and understanding dividend sustainability is critical, especially when building an income-orientated portfolio. Now, for us, the first step is follow the cash. Since dividends are paid in cash, we need to assess the company's ability to generate free cash flow. That's operating cash after capital expenditure. For industrials and resource companies, this is a measure that we look for. Ideally, free cash flow should consistently exceed the dividend payment.
And a good example of this, Matt, is Rio Tinto. While its free cash flow has historically supported dividends, the recent downward trend in their free cash flow raises concerns around their long-term payout capacity, especially with rising capex and also weaker iron ore prices.
But be careful not to jump to conclusions. A temporary drop in free cash flow doesn't always mean a dividend cut is coming. A company might be investing heavily for future growth and covering the gap with strong cash reserves.
Yeah, and another perfect example of this is Telstra. Its free cash flow dipped below its dividend payments in around 2024 due to elevated capital expenditure. However, this has since normalized in financial year 25. So context is certainly key here.
And for infrastructure, utilities and REITs, free cash flow isn't oftentimes the best measure because these businesses do require high levels of ongoing capex. In these cases, we look at operating cash flow. That's the recurring cash from operations like rent or usage fees.
And lastly as well, Matt, financial stocks like banks and insurers, they are a different beast. Their cash flow statements can be confusing as they include deposits, loan flows, and investments. And for them, earnings per share versus dividends per share is the preferred guide here. And the payout ratio, also look at that, the trend in that should be reasonable and in line with history.
And also don't forget that many businesses are tied to the economic cycle. Dividends may look generous during profit booms, but that doesn't mean that always sustainable. It's critical to look at the history of dividend payments, expectations for the year ahead, and how defensive the business is. That's what gives you insight into the reliability of yield.
Yeah, and if you're ever unsure, our analyst team is always here to help as well. Or better yet, join us for our Lincoln Live episode next Monday, where we'll walk you through some real examples and answer your questions live. But that's all we have time for today. Thanks, Matt, for joining us. It's been a pleasure to have you on board, especially on the last day of reporting season.
Thanks, Ken. It was great to be joining you again.
And as reporting season concludes, now is that time to monitor your portfolio, remove those financially weak businesses, and take advantage of incoming star stock opportunities. Until next time, take care and have a happy, healthy, and prosperous week ahead.